Good afternoon, everybody, and thanks for joining this webinar. This is, I think, the third in a series for this year, but it's been a while since we were doing this, and so welcome back to those who were at our last webinar, and welcome for the first time to those who are joining us for the first time. Our webinars run about an hour, and that's what this one's going to be as well. 40 minutes of a formal presentation, but our style is that we really don't want to do a monologue. Webinars can be very one-sided, especially just given the technology. We're not in an auditorium and people can't raise their hands and grab microphones and speak. Obviously, you guys know the technology, but for those that are not that familiar with it, should be a little Q&A box, looks something like this, somewhere on your screen. Depends on how you're organized and set up, but hopefully you're familiar with it. We really would like questions as we go. And I believe, Kevin, you're going to be our master of ceremony, and Kevin will introduce himself in a moment. But if you guys would just submit questions using this Q&A feature, Kevin will interrupt me on your behalf as we go. And that really is our preference, to make this as interactive as we possibly can, given the situation. And then we'll do a full-blown open Q&A at the end of this meeting. Recording will be available to everybody afterwards. This is being recorded, and it'll be posted by the 19th, along with this set of slides will be posted as well. Now, the format for this webinar, we reached out to people last month in August with a survey. Those that are with us right now may have participated. Some of you didn't. But we asked you, quote unquote, what you wanted us to talk about, rather than us telling you what we thought you should hear. So these 4 items were what the majority of people thought were interesting to hear about. So we're going to talk about multiples. We're going to talk about tax code changes. And interestingly, the House Ways and Means published 2 days ago some preliminary legislation. So we have something really to talk about, although it is just House and Means proposals. And we'll talk about recent deals. This was a lot of our survey respondents wanted to talk about real deal experience, things that we've really done in the recent past, where things went really well or really poorly, and we've got stories on both. Obviously, we can't tell you the names of companies, et cetera, but we can tell you the details of what happened. And it appears that a lot of you wanted to hear about that, so we're delighted to do it. And then trends in deal structures and terms. Obviously, a lot of this is driven by COVID, the recent trends in terms and structures, but other things as well. So that's the agenda. And I'm going to look to my colleagues, Lenny and Kevin, in a moment to introduce themselves. But just a snapshot of our firm, and then we'll do introductions. So for 20 plus years, we started in March of 01. For 20 years, we've done really just one thing. It's aerospace defense, it's middle market, and it's sell-side M&A. And we've got some slides we'll go through later on, talk about where we are and how we play in the market. But what I'd like to do is introduce my colleagues very briefly. And I do believe that Bruce Andrews, who was hoping to be with us today, unfortunately is tied up. So he won't be with us. But if Lenny, you would start, and then Kevin, and then Alex, if you just say a quick hello, I think everybody would appreciate that, and then we'll dig into it.
Sure. Lenny Kirsch. I have a 40-year history in commercial and general aviation, and I've worked on acquisitions on all sides in every part of a transaction.
I'm Kevin Gould. 30 to 40 years in the industry, aerospace and aviation, large companies and small. So Boeing and Honeywell, and then down the scale to Piper and Eclipse. Earlier on, it was in kind of operational roles. In recent years, it's transitioned to transactions and restructuring work. And I'm a licensed pilot, single engine land, instrument rated, 1,000 hours. So I know and love airplanes.
My name is Alexander. I'm currently a sophomore student at Cornell University, majoring in economics.
Alex is one of our interns and been doing a great job, so he gets a little airtime. So well done, Alex. And Bruce Andrews is unable to join us by video, but I believe Bruce was able to connect by audio. Bruce, are you there?
Can you hear me?
We can. Great, Bruce. I'm glad you were able to connect by audio. Welcome, welcome aboard. Do you want to say a quick hello while people stare at your still picture?
I'm sorry about that. Been working with Bill for 20 plus years. My career has been in aerospace manufacturing as well as nuclear manufacturing, turning around troubled companies. And then Bill and I have worked in a number of deals together, selling and doing consulting for aerospace and defense companies. Background is engineering, chemical and metallurgical, and then a BA in finance. Happy to join you today, although I'm sorry you don't see my photo.
Well, we see your photo, we just don't see your lips moving, so we'll have to pretend, but I'm glad you could join us, Bruce. We know you're real busy at the moment, so thanks for joining us. All right, so before I go on to more slides, everybody, I just want to make sure that people are able to use that Q&A function, and I'm going to look to Kevin in a few moments here to, and I don't think Kevin, was I not paying attention? You introduced yourself, but did you say that you're going to be doing the Q&A pit, and are you receiving some Q&A things yet?
I am going to do it, and I am receiving some initial inputs.
Excellent. Okay. And guys, please, the more you do that, the happier we will be. Sample deals. We've been all over the marketplace. I'll just pick a couple here. Go way back to sort of the beginning of the firm. We sold a company called Shaw Aero to Parker. It was in fuel controls, deal that Bruce took really the charge on. Large transaction, wonderful transaction, and one of those deals where post-transaction, everybody was actually happier than pre-transaction. A unique deal down at the bottom in the middle, EOI, Electro-Optical Industries. That deal got done in 3 weeks. French buyer, ultimately backed by Carlyle, and a private equity seller. It was in photo optics, military photo optics. I've never done a deal before or since in 3 weeks, but you never know, things happen. And so we're all over the marketplace. We have a lot of experience. We are in the middle market. That's our sweet spot. And we define the middle market as roughly $100 million in revenue and smaller. We've done larger deals. We're not stuck on that, but that tends to be a sweet spot for us. In terms of client demographics, just real quick so you understand who we are, and then we'll talk about all the good stuff. A equal mix relatively of business aviation, commercial aviation, defense, based on the size of those markets. 20% biz aviation, 36% commercial, and 46% defense. That moves around just based on client activity from day to day, but those are rough numbers that stay pretty constant. And about 50%, 44% to be exact, of our clients are in the manufacturing business, 32 are services, and the rest are distribution and other. The one thing we don't do is airlines. We do not provide M&A services to airlines, just as a matter of, it's a unique enough market that we leave that to others. And in terms of where we play, we've done publicly traded deals in Israel, but it's not our core market. We have to have a reason for going there. We don't go looking for work outside the US. Okay, so that's us. So those who don't know us, that's who we are. Those of you who know us, sorry for the repeat. The first question we were asked was multiples data. And this is an eye chart. And apologize for the eye chart, but you're going to get this slide when we're done. Hopefully you'll find that it's helpful. There's a lot of subjectivity, especially in the adjusted EBITDA column. Okay, so as you do your own research, you may find numbers that are different from that. Adjustments are adjustments. They can be subjective. They can be very subjective. And so we just caution that, you know, EBITDA margins are sensitive to adjustments. Price to revenue numbers are less sensitive, right? Because those are pretty easy numbers to just verify. So our general comment is that we actually like revenue multiples more than EBITDA multiples, but we respect the marketplace, and that the marketplace really likes EBITDA multiples and looks to them. Now, we're not surprised, and we assume you all are not surprised, that at the moment, multiples are high. Now, we'll talk later about segments and micro segments of aerospace and defense. You know, a company that's in test and measurement or C4ISR or cybersecurity is very different than a company that's making structures and components, and they trade for different values. Nevertheless, the marketplace is high at the moment, high relative to our past experience, both anecdotally and statistically. And this is a good time to be selling. We're going to talk in a few minutes about the tax code change, and maybe there's going to be some headwinds to selling. I think net there won't be, but we'll talk about it. But at the moment, deal prices are up. There's a lot of M&A activity. Volume is good. Pricing is good. It's a good time for sellers. It's a good time for buyers. There's a lot of activity. And our take on this data that we're sharing with you is that these are not all-time record highs, which would scare us. These are on the higher end, but some of these numbers are low. You got 5.7 EBITDA multiples in here. You got 4.1 multiples, 8.6, 5.4. The ultimate takeaway that we would like to leave with you is that we have a lot of this data. It's very important. We cull through it and mine it and analyze it all the time, but that it's deal specific. As an investment banker, not an economist, what really matters is who's our client, what are their cash flows, what's that company worth, what are its comparable companies worth. But when we're in that micro niche, overall general multiples in the aerospace and defense industry are relevant, but not highly relevant. But we'll send you this slide. You guys can go through it, and we would welcome a phone call or an email to discuss any of this data or any other M&A related multiples data that you'd like to see. Tax code changes. Okay. The House Ways and Means came out 2 days ago with this proposal, right? And we've looked at it. We're not tax lawyers. We're not, well, Lenny is a lawyer, and actually Kevin is a lawyer, but they're not practicing lawyers at the moment, right? They're bankers, but they do have law degrees. But it's not our job or our place to interpret tax law, right? Our job is to understand it enough so we can do deals and we can advise our clients. A simple understanding of the proposal from House Ways and Means is cap gains is going to go up 5% to 25%. And there's a unique provision of the code that has affected about 2 or 3% of our deals since we founded the firm. Section 1202, and it has to do with older C Corp companies where there's an exclusion because C Corps technically get double taxed. And there was an exclusion for that double tax provision. We're not tax lawyers. We're not going down this rabbit hole, but there is a reduction in the exclusion, which means net, an increase. So for those 3% deals that we've done over our careers, if this were to go through for those 3 deals that we've done out of about 100 or whatever it is, so 3%, there would be an increase in their taxes because there'd be a decrease in their exclusion. So let's ignore those guys because it's a tiny piece of the market. The real issue is a 5% increase in capital gains. And first of all, the question is, when is it going to come through? And that's part of what's being debated by the Congress, right? And the Senate. What's the tax code change? When does it become effective? It could legally become effective January 1 of 21. They can do that. They have the power to do that, right? They could make it effective the day the law is proposed, the day the law is passed, or the next fiscal year, or the next tax year. It's all available to them, right? Our understanding is there's nothing in the Constitution that prevents them from picking a date. It appears, well, not appears, it is at the moment proposed that there be a transition rule and that any deal that is signed, written binding contract by the date of the legislation at the moment would be grandfathered for the old tax rate. Okay, that's proposed. No one knows what's going to wind up being approved. So the question is, if this proposal were to go through, what's Alderman and Company's view of its impact on aerospace and defense M&A? And the question is, would a 5% increase in capital gains meaningfully change seller behavior? Well, our view is that things like COVID, exits from COVID, changes in the defense budget, right? Consolidation of the business aviation market and its phenomenal rapid growth right now are more powerful motivators for transactions. And as I learned very early in my career by somebody a whole lot smarter than me, taxes should be the icing on the cake. Taxes should not motivate M&A transactions, okay? So you structure them well, you make good decisions, you organize and pay as little taxes as you can, but you do mergers and acquisitions because they're the right strategic move. You're 75 years old and you want to retire, okay? You shouldn't have to wait till you're 90 to hope someday taxes go down by 3%. That's silly, okay? And we can come up with a lot of other examples. But our takeaway is, if it's a 5% increase in capital gains, probably will have a minor impact on the volume and the pricing of M&A transactions at the moment. But this is all proposed, and who knows? Okay, so now I'm going to ask my colleagues to start talking, and I want to do less of a monologue here because this can get boring for all of us. So I'll highlight the issues here, and then I'll let my colleagues address, and then hopefully the audience will drive where we want to go. And I'd like this to be sort of the bulk of this conversation, because I think this is valuable, really valuable. So let me just read the 7 items that we came up with, going through all of our deals and all of our history and all of our good stories. So number 1, as a group, we think value went up and everybody was happy, whether the deal closed more quickly, whether there was less of an earnout, whether the price went up, less escrows, whatever it was, something good happened because number 1, the company is exceeding its projections during the sale process. By far, we all agree that's the number 1 issue. The number 2 issue was just revenues ahead of plan. Net income on plan, revenue above plan. Number 3, pipeline wins better than forecast, better margins, more market share, et cetera, better customers. Number 4, those customer calls, right? The final due diligence, we want to call your customers. When they go, okay, nothing really special happens. When those customers say, we love this company and you're going to be lucky to own it yourselves, and we look forward to working with you and we want to give you more work, that's a great thing. It's not very common, but that's a great thing. Exceptional accuracy and timeliness of due diligence, segment sentiment rising, and real-time M&A peer activity at higher valuation. So those are the 7 that we came up with, and I'd love to turn it over to my colleagues and the audience to have sort of a meaningful conversation as opposed to a monologue.
You know, Bill, one of the examples that I can think of is, and this was back actually about 10 years ago when we sold Piper. It was 2009, and of course that was right after the economic debacle a year or 2 prior. And so there was a lot of, you know, kind of the outlook was fairly dim in industry, but we were able, the company had taken some very strong action right at the beginning of the economic problems and reduced their production rates dramatically. And so they kind of took the strong medicine early on. And then kind of examples 1 and 2, as we were going through the sale process, we were beating the forecasts. And that was extremely helpful in the sales process, and we were able to sell the company. So that was a matter of understanding what was going on, taking the tough tasks, and then going ahead and biting the bullet and being able to do better than we thought.
Lenny, Bruce, do you want to add?
No, good things can happen, and that's great. We've certainly had examples, Bill, where bad things have happened as well, and perhaps we'll have a question along those lines.
Yep, we're going to get to slide 14 or 13 soon enough. Lenny, do you want to add on slide 12 at all? Well, while Lenny's thinking, I'll go ahead and add to this. Number 5 actually seems sort of pedantic, but it's pretty important. We spend a lot of time working with our clients, getting them prepared for due diligence. And that work really pays off. And it's not that dissimilar from doing your homework, having your files organized. In the old days, paper files; in today's world, computer files. But when a buyer comes in and they can't get things, and it takes long, and they ask questions and they can't get legitimate answers, and things don't make sense. We'll talk about in a moment. It's not helpful. But on the other side, it's very helpful to get it all ready and organized up front. I mean, that's part of our job, is to work with the sellers and help them get everything organized and ready. But when it's exceptional, not when it's acceptable, not when it's as expected, but when it really is exceptional, it's just well organized. Everything ticks and ties. It's easy for the buyer, right? It's painless for the buyer. It actually increases value. And one of the things we have found is that for the right, very small companies, unlike some other investment banks, will take on extremely small mandates if the client has all of these sort of 7 things together. They've got projections that they're going to beat, right? They got pipeline wins that they think they really are going to be able to conquer. They know they're going to get great customer calls. They're going to have exceptional diligence, right? We're going to prep. And so when a big company comes in, whether it's a Honeywell or whether it's a big private equity firm, they come in and say, that's a tiny little company. Why should we bother? And they say, well, it's an Alderman deal. It's going to be really easy for us. It's going to be no brain damage, right? It's going to all be organized. They're not going to miss their projections. We're able to take small companies and actually get them phenomenal prices because we see and we work with all this upside. So we're going to talk about the downside now, and it's a bummer and it's a downer and it's sort of exciting to talk about. But I want to reiterate here how important this is to us, and especially the clientele we pick and choose to work with. That, you know, our reputation is only as good as our clients, and we sadly will tell some clients, I'm sorry, we can't work for you because you're not going to check these boxes. But if you are small, right, and can check these boxes, we can get you a great price, even though a lot of companies are going to say too small. Go ahead, Kevin.
Hey, Bill, we've got some questions coming in, so I'd like to pose them to you. Have you noticed an uptick in the multiplier for defense contractors? There seemed to be significant stability during COVID. Had this translated to increased value?
Great question. Before the drawdown in Afghanistan or the pullout, generally speaking, the defense budget was stable across the board. And whether you were making widgets or software, values were strong and stable. Okay. The issue is with the drawdown and the pullout, traditional defense spending has become a microcosm of value. So if you're making bullets, as a silly example, that are used in Afghanistan, you're going to see a decline in revenue, earnings, and value. If you're in cyber, you can't meet demand. And so the comment of how are defense multiples? Well, Bruce and I are on our second, well, as a firm, we're on our second defense electronics transaction this year, which should close shortly. Okay. Defense electronics are white hot. It's not just white hot in terms of values are high. It's white hot in that we've got a company that we're selling. They're really working hard to meet their customers' demand. Demand is just as high as it's ever been, never been before. And so they are just focused on producing high quality and shipping. When you're in that environment, you're making a lot of money and you're very valuable. So the answer to your question, your participant's question is, defense, generally speaking, too broad of a question today. You got to dig down, and if it's defense electronics or cyber, multiples are very high because revenues are very, very much up. But if revenues are down because you're making bullets, then values are down.
Okay.
Yeah, can I add to that, Bill? Can I add to that?
Of course.
Yeah, I'm sorry. We do see segmentation for sure in the defense market. And as Bill said, bullets versus cyber. And it also has been helpful, certainly recently in the past several months, that the strategy of fewer boots on the ground versus intelligence, cyber, and advanced missile and defense systems is really, really hot again. And as Bill said, we are seeing much more activity there. And that's good news for those companies that are in those segments. And it's helping multiples for sure.
Good comment. Thank you, Bruce. Lenny, did you want to add something? No, Lenny had to drop off. Okay, so
next, got a couple more questions, Bill, if it's all right.
Sure, of course. Well, how are we on time? Yeah, we're okay.
How is buyer due diligence focus changing, if at all?
So we've got a slide later on that I'll defer to, so I'll half answer the question. There's a COVID bump, and we'll talk about that later on. But this concept of COVID bump, that's new. We've always had exogenous factors, adjusted EBITDA, bridging. Those concepts aren't new. And whether it was that there's an AD on the airplane, or there was a grounding of your equipment, or the government changed over some military technology, there are always anomalies to analyze and diligence. But COVID truly is, unfortunately, still unique. So we'll talk about the COVID bump. So my answer to the question is, the COVID bump has created some new diligence items, but they're along the same lines of extraordinary events that have always occurred and always will occur. But we'll talk about it more later on. I'm going to have a cough drop so I don't cough more at people. Lenny, are you back?
Yes, I'm back.
All right. Did you want to say something earlier?
No, I'm fine.
Okay. All right. Kevin, shall we roll forward?
Okay.
Unless you have a question you think I need to answer. Up to you,
No,
Kevin.
you go forward. I'll bring these up later.
Okay. Excuse the cough drop, folks, but I guess it's better than coughing. So look, the chart's red because these are bad things. One thing I don't want to do is be Debbie Downer. I don't want to say that we have downside surprises more than upside, because we don't, okay? And the reason we don't is because we protect our clients and help them not do this. And so we've seen these, and they're train wrecks, okay? Let's not, be nice about it. Each and every one of these is a train wreck. But Kevin and Lenny and Bruce and I don't enjoy train wrecks, okay? So when we see the train is going too fast around a corner and it's going to come off the tracks, we don't let it, okay? And we do our due diligence, and we work with the client before they get in front of a buyer so that train wrecks don't occur. So we'll have some fun. We'll talk about all the train wrecks and all the ambulances, but we are not ambulance chasers, okay? And we don't want train wrecks. And so while you'll hear these, a lot of these are old stories, and hopefully these are very seldom for us. They're entertaining, but they're few and far between. I don't want you to take away the message of, wow, these guys have a lot of junk all the time, okay? Because we don't. We have great clients. All right, gentlemen, have at it.
So let me speak first, please. So I think our firm takes the view that you have to expect the unexpected and keep asking questions, keep looking into the possible risks. I had a situation where my client at an airport was the sole provider. I asked again and again and again, is there any possibility of competition? We told all of the buyers who were interested and the final buyer that we cannot ensure there won't be competition. But despite numerous questions, despite numerous phone calls to contacts at the airport, at the meeting right before closing, we were introducing the buyer to the airport authority. The airport authority announces that within 30 days, they're planning to put out a bid for a second supplier. It was a total shock for the system. It didn't kill the deal, but it did lessen the closing price. So you expect the unexpected. You do what you can to make sure you know everything going on, but sometimes you have to deal with reality.
Yep, good point, Lenny.
Bill, we've got a question that pertains to some of this. What percentage of your auction deals has the buyer tried to renegotiate the price during due diligence for trumped up reasons after he won the auction?
Great question. The answer is infrequently. The answer is trumped up reasons, just about never. And the answer is that we have, unfortunately, for the exact reasons Lenny was talking about, we say to a client, how are the quality of your earnings? We know you're audited. How's the quality of your earnings? Oh, it's fine, Bill. How's the inventory? Oh, it's fine, Bill. Are you sure there's no excess inventory? Not worried, Bill. Are you sure there's no obsolete inventory? Sure, Kevin, we're not worried at all. Okay, well, in due diligence, there's excess and obsolete inventory, okay? Now, fooey on us for simply asking and trusting and not verifying, right? Ronald Reagan said it better than anybody, right? Trust but verify. We do the same with our clients. We don't trust. We love our clients, but we're trying to protect them from themselves. And so when we get a quick flip answer from a junior executive that says, yeah, don't worry about it, we say to the owners, do you mind if we worry on your behalf? And so when there's trumped up reasons, The answer is just about never, because we push back. We say, look, in this SIM, here's the documents, in the data room, here's the facts. Your issue is nonsensical. But where a buyer legitimately says, we did a quality of earnings and your numbers don't work, it's just based on GAAP. This is the fact. Here's the spreadsheet. What do you want to do about it? Well, the answer is, what are you going to do about it? And guess what? If you go back to the marketplace with the facts, you're going to end up in the same place anyways. So what we always tell our clients always is, take care of these 7 issues, get them addressed. Then let's go get a premium for the business. Because if you try to get a premium by wiggling through one of these 7 problem areas and not resolving it and think that's how you're going to get your premium, most people that wire transfer $100 million aren't stupid, right? They're going to figure it out. So that's really where we put our work. But, you know, have we seen trumped up tries? Of course we have, infrequently.
Yeah, Bill, is Bruce. I would add to that. And in the 20 years, I can't remember truly trumped up tries by a buyer. Our buyers tend to be extremely ethical and above board, but they do come up with legitimate concerns about things like inventory and quality of earnings, for sure.
Yep. And Bruce says, one of our tasks is to vet the buyers, okay? And we try only to bring to the sellers buyers that are ethical, credible, and, you know, obviously have the money to close. But, you know, we don't want to bring an unethical buyer to our seller. That doesn't help anybody.
Okay, one more question, Bill. Inflation assumptions are not on the downside slide, but different buyer and seller assumptions could create material assumptions as valuations. Is this a current issue?
That's a wonderful question. Whoever asked it gets an A+ on a gold star and an apple. Can I scroll to other slides? Table that, Kevin. Don't let me ignore it. Let's do that when we get to one of the last slides.
Good.
Which I think is not that far down the road. And I've got 35 minutes. Oh, this is the slide I wanted. So we're almost ready for full open Q&A. Okay, so I'm going to skip the first 4 items, go to the 5th item, bottom right, big changes, and address your attendees' question. And then I'll go back to the top left. So what's changed because of COVID, right? And the question that's been asked is within this set of questions or set of discussion. What's changed in cash flow modeling is the way buyers are looking at historic numbers. They've always adjusted historic numbers for, as I said, exogenous factors. There was an AD, there was something unique that happened. The COVID bump is extraordinarily unique, right? And it's both positive, negative. There were cash inflows because of COVID, and there were massive increases in revenue for some products and services because of COVID. Silly example, right? Unrelated to us. The manufacturing of face masks, okay? It's a silly example. Demand for face masks has got to be up 3,000% or something. I don't know. It's got to be ridiculous, right? So if you manufacture face masks and you're doing an M&A transaction from selling face masks, you got some weird numbers to look at, right? Okay, that's an exaggeration of the COVID bump. Another silly example of the COVID bump is you own a bar in Toledo, right? Well, last year you got destroyed, okay? Those are silly examples, but that's the reality. So when we're doing historic cash flow modeling for the seller, as the seller, getting ready to talk to the buyer, you got to fix all this stuff. What do you do with all this PPP money? Or you may have CARES Act, and that's a unique subset of the act, and different companies got CARES Act versus PPP. What do you do with all that money that flowed through the income statement? What do you do with it? DLA accelerations. We have clients right now that we're selling that manufacture certain things for the DoD, which get purchased by DLA. And for some companies, DLA gave 95% of the cost of the product to the manufacturer before they started production. It was effectively a working capital check, line of credit to fund the entire company. Okay, that's not normal. That's going to go away. What do you do with that money? Working capital changes. Supply chains got frozen. Well, that disrupted working capital ratios. Okay, so this COVID bump, we do a lot of work analyzing and working with our clients to package their historic numbers so that the buyers can accept, believe, and agree and have a very similar view. So your attendee's question was, what do you do when they have a different view of the numbers, of inflation, whatever, okay? Historically, you got to get them on the same page. Now, they may say, well, the PPP should be here, not there, but we show everything we're doing, we justify everything we're doing, and we hope and we think buyers will go along with us in our view of historic analytics. On the projections, look, number 4, inflation, okay? We get it, okay? There's a timing of return to normal, whatever that means, RTN, and how it affects your business. Look, if you're in the cargo business, right, times are really good. You're not necessarily waiting for a return to normal, okay? Because air cargo is up. But if you're a passenger airline, you're waiting for RTN. It matters to you, right? How do you project that, okay? How do you project inflation? Will we have inflation? Will it be low? Will it be high? What about outside the US? Tax code changes. Hello, we have no one knows what the US tax code is going to look like when it's written. I mean, nobody, right? It is in flux and it is being debated, hopefully civilly, hopefully peacefully, and hopefully our government will get something done right. I mean, the PPP CARES Act, forget politics. Our government did a great thing with the PPP funding. And we all, I think, agree economically, hats off, congratulations, our government did a good job. There's a lot of nonsense, but they did a good job. Hopefully they'll not do a bad job with the tax code changes, but nobody knows. So the answer to the question, long-winded, is you got to model it. You have to build a model and assume inflation. What do we recommend right now for most of our clients? Assume modest inflation. You want to use 3.5, you want to use 2.7, you want to use 4. We don't see buyers demanding 12% inflation every year. It's not what they're demanding. But if you put 0 inflation in your models, you're going to get beaten up. All right, let's go through this slide from start to finish, and then we'll go to open questions. Microsegment divergence. This is the comment that I made earlier. Excuse me. It really becomes micro at this point in time. It's not how's A&D, how's defense, how are multiples here. You've got to dig all the way deep and down. Like I just said, you could be in the business of supplying toilet paper, fuel to the airlines. Well, are your customers passenger airlines or cargo airlines? Because saying what's your multiple because you supply the airlines doesn't work anymore. They're totally different markets at the moment. They may go back to being similar value and similar revenue streams, but at the moment, you can't say how are airline suppliers doing. It's just, they're 2 different markets. Afghanistan sustainment versus mil cyber. I mean, come on. One's going to 0, and one has just gotten the president to say it's going to get a huge increase in funding. Okay, so you can't say how's defense. You got to say exactly what microsegment of defense. That's the biggest thing that we've seen as a result of what's going on in the world right now. Earnouts. You would think when there's a divergence and things are in flux and volatile, you'd see more earnouts. That's what we would expect. We're just not seeing it. In our deals, we have 6 deals in the marketplace right now. We closed a similar number of deals last year. And we don't have an earnout. We had a small earnout in one, a tiny, like less than 2% earnout in one, technically speaking. Okay, so we don't see it. That doesn't mean the data doesn't support it, right? The SRS AQUIM is a good source of data. They're saying that the number of deals that had earnouts was up last year, and we're waiting for the 21 numbers. It's up. We agree it should be up. We're not seeing it. That's all. Anecdotally, 6 deals doesn't make a marketplace. Remote due diligence. This is a big deal. We've done deals during hard lockdown. We closed a defense electronics deal that had some operations outside the United States in a NATO-friendly jurisdiction, of course. All due diligence done without crossing any borders. Retained professionals in each jurisdiction, and then obviously would remote work on it. But we did that deal completely remote. And we believe long-term remote is going to be part of the deal business. Not exclusively, not never meet in person again, but it's going to aid the deal process. Deals will happen faster, we think, as a result of technology. Expansion of MAC, you would expect after the terrorist attack, MAC, Material Adverse Change Clause, MAC started to include terrorism. Surprise, surprise. Guess what? MAC is now including global pandemic. Surprise, surprise. It's not a big deal, but it's happening. And then I talked about the cash flow. All right, so I think That's the end of my presentation. I want to do a quick little plug for Alderman and Company for 2 seconds, and then we'll do open Q&A. Members of the staff that you're talking to right now will be speaking at 2 flagship events going forward. If you like what the team had to say today, come see these events. One is the Aviation Week Speed News event in October down in Washington, McLean on defense. And the other is the A&D Mergers and Acquisitions Conference in California in November. We'd love you to attend those, and one or more of us will be speaking at each of those events. All right, I'm done. Open Q&A, and Kevin, I think you're in charge.
Okay, next question. How do you think about multiples for businesses that provide peripheral services? For instance, assembly, supply chain management, finishing, et cetera, in the aerospace and defense industry?
Am I supposed to take that, or can I let one of my colleagues answer that one? Or even you, Kevin?
Yeah, I mean, when I think about the associated companies that work with and are dependent on aerospace and defense, I think it tracks pretty closely. The only caveat is that with this kind of the impacts, adverse impacts of the supply chain that froze up over the last 12, 18 months, that there may be some larger operations that decide to vertically integrate and reduce their risk, become less dependent on outside suppliers that can fold their whole organization. And you think about large airframe manufacturers, and they've got 100,000 parts that go into a 747 back in the day. And if you've got one special bolt that you can't get it, everything stops. And so I think that there's an attempt to try to perhaps vertically integrate more, or at the very least, start to build up inventories of critical components. And instead of having these just-in-time inventory policies, start to build up some buffer stock for key vulnerable parts and components.
Great point. Hey, Kevin, I'm reading a question here that I would like to answer, if that's okay with you. You're in charge, but can I have permission? So a gentleman asked, made a comment, and I'll read it. As an acquirer, I do not get excited about a company reporting earnings ahead of forecast. It implies to me a potential pull through of profits and an inability to forecast. Okay. I love the comment. So, and it goes back to our slide with the green things about earnings ahead of plan, right? I think it's a question of the extreme, right? And public companies are good at this, right? And they are 1 penny ahead of plan, 2 pennies ahead of plan. It gets to be a little bit of a joke after a while, but that's what most companies report. So my comment to this attendee is 100% agree with you. So we're not proposing that we go out with projections that say we're going to make 4 million of EBITDA and we report 8, because we couldn't agree with you more. That's going to turn buyers off. But we would much rather have you forecast 4 and report 4.0172 versus 39678. It is truly psychological. It sort of makes no sense. But we really believe, and we've seen it time and time again, if you're up by 1 or 2 or 3% over your forecast, it is dramatically better. I still don't understand why this makes any sense. When you miss your numbers by 3%, for some reason, it's 100 times worse than the 3% over is better. And I know that's a bad sentence, but you know what I'm trying to say. So our comment is agreeing with you. You don't want to wildly exceed your projections, but you sure don't want to miss them by 2%, because silly things happen when you do.
Okay, next question. What is best practice for both sellers and buyers on getting third-party or industry program data, past and future, for where your clients are selling components or services into specific programs, for example, the F-35, thinking of build rates, et cetera?
So the answer is, if the client can afford it, they should retain one of the great consulting firms that are known in the sector. So if it's a build rate in defense, you go to a Renaissance, okay? or Richard Abalafia's Teal Group. If it's a build rate on in or a production rate, a flow-through rate in MRO, you go to Kevin Michaels. Okay, so the answer is, and we always advise our clients, if they're willing to spend the money, they should go to one of the experts and get a forecast, which may not be what they want to see, because people like Richard Abalafia and Kevin Michaels don't give you what you want to hear. They give you what they think the reality is. So the answer to this question is a great question. If you can afford it, you go third party, you go to the best, and you get a legitimate third party independent forecast and you work with that. If you can't go to the best, my recommendation is sort of don't waste your money and do the best research you can on Google. We'll help you. Okay, we know some of this stuff, but we are going to be pretty strong in our view and our recommendation that you need to hire somebody like these people, not because they're our friends, but because they have our respect, and more importantly, they have the respect of the buyers.
Okay, next question. Any trends in financially stressed lender fatigue motivating sellers? And I guess the first thing that comes to my mind is not particularly, not like you might have expected. And I think there is some optimism that there's going to be a rebound, and maybe some of the economic support that the government provided kind of built that, but haven't seen a lot of lender fatigue driving sales yet. Some of the other folks on the panel may have different viewpoint.
Kevin, I just spoke with a gentleman who runs a MRO business, a large one, and privately owned, but very large. And he said that his banks are now starting to give him a hard time. So okay. I think you're right. And Bruce and I were talking about this a lot the other day. The PPP funding worked. Okay. And if you were a bankruptcy lawyer, it was miserable because it worked and companies didn't go bankrupt. Right. And we spent a lot of time talking with the Turnaround Managers Association and lawyers. And we, before the CARES Act, expected a plethora of commercial aviation bankruptcies. The funding came through and the act came through and we're like, that's gone. I mean, I'm glad, but we're not going to be doing 363 bankruptcy sales because these companies aren't going to need it. Now, I don't think personally, I'm not sure if the firm agrees. I don't want to speak for you guys, but I don't think there's more PPP related money coming out. And I believe the majority of sectors of the economy are going to be okay. This pandemic is getting to be behind us, I hope. But I think niches like MRO for long lead time commercial aviation may be sluggish to come back. And while it's sluggish, there may be negative cash flows for some people. And there may be banks that get a little bit skittish. And in talking with my friend, who luckily is cash positive and has a good balance sheet and he's not at risk, but he already is hearing from his CFO and his banks, they got to change banks because their bank doesn't like aviation anymore, right? And so to a company that has a great balance sheet and lots of cash, that's just an administrative nuisance, right? So luckily for my friend, but if my friend didn't have a strong balance sheet and was in cash flow losses and that bank said we want out, now we're talking about stress. So I think the answer for me is for certain micro niches, I think there is some distress coming and it's going to be caused by the banks.
Good. Next question. Can you comment on M&A interest and activity in the space sector, particularly commercial space?
Do one of my colleagues want to take that or do I have to do that?
Yeah, this is Bruce. There is some increasing activity for sure, and some long vision thinking buyers and sellers out there. We're currently talking to a company that services, a good part of its business is serving the commercial space marketplace for unique solutions, modeling, software, testing, simulations, that sort of thing. So there are certain advanced technology companies that are doing well, and I think will continue to do well as that segment of the universe, if you will, grows and demand increases. It's not huge, but it's significant, certainly to these companies. And I think there is a potential future for them. I really do.
Yeah.
Me too. Me too.
Good. Next question. And this one's about cyber. The cybersecurity maturity model certification will have a major impact to the defense industrial base.
Yep.
Are you assessing clients' compliance with NIST 800-171 and their submittals to supplier performance risk system? Also, their management of controlled unclassified information.
Yep. So I'm going to start, and I'm going to hand it over, I think, to Bruce, because Bruce has stories as well. Look, the NIST and the CUI and FedRAMP wasn't mentioned, but it's also in the mix. FedRAMP. We as a nation are at risk of cyber attack. It's going on all the time. We all know what happened in the news. And what is less public information, and it's public enough that, I mean, it's public, I can say it on this call, it's not classified, but it's just not in the media, is that the major global attackers on cyber, the Chinese, the Russians, North Koreans, etc., they're no longer hitting the Rockwells, the Raytheons, the GEs, the Lockheeds. We were on a open advisory panel not long ago on this issue, deep in the supply chain where we live, right? Small companies. And the comment was made by a very senior executive covering cyber at a very large company, defense contractor. And he said, our hits have plummeted. They're just not attacking us anymore. They know we have decent defenses. It's our tier 2 suppliers that they're now hitting. And they're telling us they're starting to hit 3. And they're telling us now, real time, they're starting to hit 4. And let's assume 4 is as small as they get, right? There's no tier 5. Tier 4 is $100,000 in revenue, okay? And so what the Chinese and Russians have figured out is XYZ company, Lockheed Martin, has good cyber defense. It's a hardened target. Let's go soft. Why am I hitting a hardened target when I can go soft? And by the way, I can get in upstream through that soft target. So the defense industrial base gets it. The issue is these little companies are having trouble affording it. That's the issue. But we believe as a firm, NIST, CUI, FedRAMP, all of it is critical. And these companies have to make these dollar investments, or they're actually going to get shut out of the DIB, the defense industrial base, soon enough. It's too much of a national risk. And so I will say that not a deal that Bruce was involved in, but that our firm did, one of our other MDs did, in earlier this year, that was in a related government industrial base activity, and they got hit during the sale. Okay, literally hit during the sale. And Bruce, I think you have a story you want to share.
Yeah, we are currently finishing up an assignment for a great defense electronics company that got attacked just shortly before we began the engagement. And they weren't adequately prepared. Fortunately, transfer of information, of classified information, didn't occur. But they certainly penetrated shells, and huge investments are being made now to upgrade the security and cybersecurity systems, hardware and software within the company. And we see it everywhere, Bill. We've seen, gentlemen, we see it more and more as the defense. I think there's an increased sensitivity of protecting defense information, uncontrolled classified information and truly classified information. There's a huge sensitivity to that. And it's something that has to be dealt with as we process a deal, for sure, and respect. And we absolutely have to make sure that these folks are on their path to being compliant to the NIST requirements.
Okay, good. We've got 2 more questions right now. The first, for companies heavily dependent on commercial aviation for their revenues and EBITDA, how do you model your cash flow projections with unknowns, like the return to pre-COVID level for long haul or business class travelers?
Lenny, do you want to take that one or you want to punt it back to me?
I want to throw it back to you. I just want to mention something. So there are always opportunities at times like this. So for example, we were talking about airlines. Well, the airlines now have great incentive to outsource a lot of their business. So I think a lot of companies providing services to commercial aviation have this huge opportunity ahead of them.
It's a great-
Bill, I would add that I think that when you think about how do you forecast the future? Is it going to be just going back to pre-COVID? You got to figure out, or have there been structural changes in that particular industry segment? Our business traveler is going to split their time now and say, I only need to travel half as much because I'm going to do half of it on Zoom. Everybody's doing it. It's accepted as a business practice, and there's some efficiencies involved. So that's one element. A second element is the safety of the aircraft itself. When you put a couple hundred people into a sealed aluminum tube for 5 hours, is there a risk or perceived risk of more any sort of pathogen transmission? And there's a heightened awareness to that. Third, has there been a migration down to business travel instead of commercial airlines? Are the business class aircraft and the charter business, have they seen a spike up? And is that going to persist? And so those are the kind of factors you need to take into account and come up with some well thought through projections on.
Yeah, I will say that we have one deal in the marketplace right now where the buyer and seller are ignoring projections. It's not an asset transaction. They're not valuing it based on liquidation. I mean, it may be an asset transaction, but that's a tax question. But in terms of, are they liquidating the business? No, they're selling the business. But buyer and seller have agreed, because they are so impacted by the COVID bump, that projections right now are not helpful. So what they're doing is other cash flow analytics, synergy analytics, cost takeout analytics, cost revenue analytics, revenue growth analytics, and historic analytics pre-COVID. But there are no 24-month projections in this transaction. It's one of the, I'd say not the only, but one of the very, very few times where we do a transaction where we're not working with projections, but it's happening. So the answer to your question is, it is a problem, and in certain unique niches, you just can't go there. I mean, you gotta literally predict the return of traffic on certain routes that are in the middle of partial lockdown. You can't do it.
Okay, final question. Timing is perfect on this. How do acquirers view PSP and PPP funds? Is it seen as a plus, or is it discounted in evaluation? And my quick reaction to that is, when you think about the forgiveness of PPP loan showing up in other income down at the bottom of the income statement, yeah, it gets backed out. That's not an operational earning that should be given value in determining the value of the company. And so it gets discounted.
Yeah, I agree, Kevin, but your esteemed colleague Lenny made a great point just the other day, which I agree with you, Kevin, but Lenny made a point that actually has me disagreeing with you a little bit. And that is the following. Lenny said they got PPP money and they didn't lay off anybody. If they didn't get PPP money, they would have laid off some people. Not all of them, because they want to keep them trained and ready to go. So when the business recovers, they have good staff. That would have cost them. But if they didn't get any of the PPP money, they would have reduced expenses by X%. And so I agree with Lenny that, Kevin, I was before saying for every deal we looked at, PPP money 100% off the P&L. I think Lenny's actually got a sophisticated, more intelligent way of looking at it, saying, what would this business have done if it weren't for PPP? And can we give them a partial credit of some of that reduction? It's a great point, Lenny.
Thank you.
Real good. Real good. That's the end of the questions, Bill, and I see it's 10 o'clock.
It is 10 o'clock where you live. It is 1 o'clock where I
On
live.
the West Coast.
All right, we're going to say goodbye to everybody. Thank you for doing this. Hopefully it was helpful. We answered your questions, I hope. This will be posted by the 19th. You will get emails and information about how to access, and you'll be allowed to share those with colleagues and friends, whoever you want, both the slides themselves and the recording. And we thank you very much for joining us, and we'll hopefully see you at our next webinar.
Thank you.
Thanks, everybody.
You.